been a bleak couple of weeks for investors, particularly in locally focused shares, notably banks. Between the 24th of March and the 7th of April, the South African banking sector lost nearly 15% of its value. 136 billion rand in value, wiped off the value of shares in 2 weeks. South Africa's bank stocks have been under pressure since then, and more so following downgrades of South Africa's sovereign credit rating. This is the Moneymakers. I'm Bruce Whitfield. Tonight, we talk about this corrosion of value in banking shares and whether or not they are still a buy. Korner Perspective Director Graeme Korner was with us in January, in which he said, yep, the value is good. Profitability is looking positive. But he's not going to buy them just yet because there's still a 50-50 chance of a downgrade. And you were right, Graeme Korner. You got the 50 right.
Well, it's 100% now, 100% chance of a downgrade. Yeah, and I think what we were saying, Bruce, at the time we were talking about how well run the South African banking scene is, well capitalized, good liquidity buffers. At the time we were saying it looked as though rates would be cut late in 2017. That's
and it was so interesting. At the last MPC meeting, one of the members of the Monetary Policy Committee actually did push for a 25 basis point cut. 5 other members said, no, let's hold off till the next meeting. Well, that's off the table now. Thank you very much indeed, one would expect.
Yeah, so I think when we met in January, we were saying, although the operating environment was looking slightly better, you'd already seen some of the big banks talking about improving non-performing loans and improving credit loss ratios. We said just wait, because if we get a downgrade, it's going to hurt SA Incorporated and it's going to hurt the banks from a funding point of view, principally. So we said, look, why pay 150 Rand for Standard Bank when you might be able to get it at 125. It's not quite there yet, but I think that view was correct.
It was correct, and hindsight is perfect. And
sure.
But you were right. We had foresight, which is better.
Yeah.
So at what point? Is 125 still a level at which to buy a Standard Bank? Because that's only slightly less than ICBC, its biggest shareholder, 20% shareholder, Industrial and Commercial Bank of China.
Yeah.
Paid for a stake in Standard Bank 5, 6,
More,
7, 8 years ago?
Yeah, absolutely right.
That's gone nowhere in a decade.
Yeah, and the profitability has improved. So I think quite a few shareholders, one of the reasons I suppose that Barclays PLC is looking to further divest from Barclays. But I think the South African banking scene has obviously faced some headwinds. The years of just pushing through inflation related fee increases are gone. We've seen, on balance of arguments, those inflation increases actually turn negative in the last few years. But I think it's a well-positioned industry in spite of the pressures. I think if you look at the likes of Standard Bank, I think they've done quite a lot of good work over the last while. First Rand, of course, has led the pack in terms of being on the front foot and has got the best cost-to-income ratio out of all of them. But I think you're absolutely right. In the better part of a decade, Standard Bank and Barclays have gone nowhere. So
Nedbank has seen a massive recovery from being broken and being bailed out by Old Mutual. There's been a big recovery there.
Sure.
First Rand, also strong recovery after its shambles around proprietary trading pre the financial crisis. But raises the question whether or not buying a bank share is ever a sensible idea. Sure, you might get a decent dividend yield over time, provided you buy at the right sort of level. But you don't get capital appreciation unless there's a turnaround, fixer-upper, or in the case of Capitec, a startup scenario.
So I think, Bruce, the simple truth for us is that just because a share has done nothing for 3 years or 5 years or 10 years doesn't necessarily mean it's a dud. If you look
what makes a dud then? If something does nothing for 10 years?
No, but what I'm saying is if you bought First Rand 5 or 7 years ago when things looked pretty bleak and you paid 18 or 19 Rand. And in fact, I was just looking earlier today at one of our client accounts. We were buying them, I think 5 years ago at 18 and 19 Rand, even at 45 Rand, you're doing very, very nicely. Equally, when we spoke in January, we were saying with Nenegate, we were buying the likes of Standard Bank at 99 Rand. So even at 135, you have actually made money.
Fair enough.
So I think
it is all about the starting point.
Share prices are like almost a snapshot. It's like taking a view on a balance sheet. What does it look like right now? The point that I wanted to make is that I think we've got to be a little bit cautious when we say, okay, well, South African banking scene is going to give you between 5 and 10% earnings growth for the next 2 years. Because I think, in answer to your question, do you buy them now? Shall I describe the South African socio-political scene as somewhat fluid at the moment?
There's a career for you in the diplomatic corps if this investing thing never works out.
Well, you said it was the understatement of the year. But it's incredibly fluid. In answer to your question, we actually see value right now in Barclays, Africa, in Standard Bank. A little less though in First Rand, because I think they've managed the cost base very, very well. But having said that, there's an old saying in the market: you don't try and catch falling daggers. But given the sort of very uncertain environment, it almost feels like you're trying to catch falling chainsaws, because you really are taking your life in your own hands. Having said all of that, PE multiples of 8 or thereabouts, dividend yields of 6% and even into the 7%, those feel like odds that you can almost make money off. And
However, let me paint a scenario for you. Malusi Gigaba doesn't get the message that is being sent very loudly and very clearly by the international investor community, by the bond market. And he continues to talk, and he hasn't, to be fair to him, since his first press conference about radical economic transformation. He's toned down his language. But say he does give a nod and a wink to a nuclear deal of 1.6 trillion rand, and he does start pushing the envelope somewhat. And suddenly there is no capital to be lent. Suddenly more jobs are lost in an economy where unemployment is sitting at 27% anyway. How can banks muddle through that mess?
Well, I suppose what I would say is the banks muddled through the PW Botha era, for example. But I think you're absolutely right. We are, and that's why I'm saying, wait, don't try and catch a falling dagger. Just see where this thing goes to. So there is value, but I think, as I said in January, just wait.
So, but we can wait, and we can spend all our lives waiting. We wait till what? Does somebody wave a flag and say it's okay to buy banks now?
Well, I think pretty much, the phone will ring, or a bell will ring. But all jokes aside, I think exactly what you're talking about. The rhetoric around was Minister Gigaba put in to drive the agenda of radical economic transformation and to sign a trillion-plus rand nuclear power deal. If that is the case, then all bets are off. You probably never mind South African banks. You don't want to own South African retailers. In fact, you only want to hold rand hedges. So what I'm saying is you need to, in this fluid situation, see how things play out. For example, now the 18th of April is an important date. It may or may not be an important date. But as December draws closer...
It's a critical date, because that is the vote of no confidence scheduled date. And that either means that President Jacob Zuma remains in office as ANC president until December, or is removed as ANC president and president of the country. And that gives us a completely... It is a fork in the road opportunity.
So Bruce, I think that's what I was trying to say in January. Don't try and make a decision now based on theoretical value, because frankly, if we talk about a sharply weaker rand, inflation not moderating but actually remaining above the 6% band because of rand weakness, and we talk about no rate cuts, which was kind of the base case scenario just 2 weeks ago.
Yeah, that's true.
It changes the non-performing loan scenario, changes the whole economic scenario. So at the risk of being flippant, you do actually have to watch it on an ongoing basis. But if we did see a political turnaround, if we got more clarity from Minister Gigaba that it is a business as usual scenario, and we saw from all state institutions related to money, so the Reserve Bank, Treasury, the Finance Ministry, if all of them were singing from the same hymn sheet saying it's business as usual, don't panic, we're not going to mess around with any of the other institutions, then I think you can sort of take a little bit of a sigh of relief. And who knows, maybe the 18th of April is a complete watershed. But if we don't get it in April, then December will be a huge watershed. We're saying the same thing. Don't go and take a bet on Standard Bank at 137 Rand or 135 Rand, because you've got no visibility. It's almost like taking a red or black bet.
I cannot believe that I'm about to suggest this, but 2 weeks ago would have been a better opportunity than now. But why bother buying a South African bank when you can buy Wells Fargo, or you can buy Nike, or you can buy virtually anything else anywhere in the world right now by using your discretionary offshore reliance?
okay, now we're entering a completely new domain. And what we're doing, because I think one of the things that I've been reflecting on, or we've been reflecting on, is the extent to which there's been effectively a balance sheet freeze by a lot of corporate South Africa. And I mean, a lot of guys were saying, oh, you know, government must get their house in order, and we back Graeme Korner blindly. And yet, if you look at it, you know, negative gross fixed capital formation, negative investment by SA.
They were talking it, but not backing it up with money, simply because there was that insecurity that he was as vulnerable as the rest of us.
So you basically get to one of three scenarios where somebody's only got a local portfolio. You'd probably say, well, maybe I should rather buy Aspen than Standard Bank. There's a lot of merit in that argument. And the reason is that the South African banks really haven't done very much in terms of investing and trying to grow and drive long-term earnings growth. You'd say, well, they're a victim of GDP. But having said that, you know, you go and look at companies like Discovery. You look at companies like Aspen, for example. Even a lot of people argue with me, but you look at a company like Steinhoff, who's gone on the front foot and done good things. All of those shares that I'm talking about give you rand hedge protection. So if you don't have the luxury of taking money offshore, you can go and buy those. And even a Sasol, for that matter, might make a lot more sense. Where people have got both local and foreign portfolios, I would agree with you. You'd probably say, which has been our base case for a while, you'd rather go and buy HSBC or maybe even a Stan Chart. Wells Fargo have issues, shall we say, but you'd rather do that. And where people have got complete flexibility and they say, look, essentially I'm purely looking offshore, then, you know, the whole world opens up, and then you say, well, if you want to, you can go and buy Tesla. You know, if it's good enough for Tencent, it might be good enough for me. And, you know, so I think you almost want to say, if you're purely SA, you're kind of looking to get some rand protection and buying good value stories. If you've got the blend, you've got both local and foreign, you take a fairly mercenary view between an HSBC or a Standard Bank. But increasingly, clients are saying, you know what, I'm divesting of SA Incorporated, like listed South Africa, and then you look at the big, bold world. And I mean, then you might even start bringing in other, you know, the technology plays and the pharma companies and all sorts of things. So I think your point is well made. Why buy a South African bank when you can buy Aspen as an alternative? Makes a lot of sense. Or why buy a South African bank when you can possibly... I speak with forked tongue. I think HSBC has run ahead of itself.
But there are global options.
There are global options. So I think that point is well made. But having said all of that, there's value. If we get to a steady as you go and it's not a low road scenario, then these banks give you, I think, arguably a money-making opportunity.
There we go. Thank you very much, Graeme Korner. And he's put it so nicely into the MoneyMakers. Graeme Korner, Director at Korner Perspective. More issues, more stories, more bad news, more good news, more silver linings and dark clouds next time on the MoneyMakers. Till then, good night.